Hello, everyone. I hope you are all staying healthy and dealing okay with this coronavirus situation. I'm sending out this video today to let everyone know of some changes we made in your investment portfolios. These changes and this video do not require a response from you. I just wanted to keep you up to date on what your investment team is doing. This video will be about 10 minutes long, so grab a beverage, relax, and come along. I'll be talking about 1, the changes we made, 2, why we made the changes, and 3, what we plan for the short to intermediate term moving forward. Now, I'd like to introduce Mike Gilman, who joined our firm here in the last couple months. And Mike was the head of finance at SunTrust Mortgage, and then they merged with BB&T and became that new name. What's that?
Truist.
The Truist now. It's lovely. It's a beautiful name, but we haven't figured it out exactly what it means yet. But so when they merged with BB&T, though, they decided they were going to move some of the executives of the mortgage company out of state. Mike didn't necessarily want to move out of state, so he and I had the opportunity to meet through our wives, and then here's the end of the story. He's joined us, and it was an awesome opportunity for us. So welcome, Mike. Good to have you here as an advisor in our company. So, Mike, you might, if you would, just go ahead and start them off with what we actually did.
Okay. First, thanks, Carl. I appreciate that. Good to be here. Today, we made an adjustment to the allocation of your equities in your investment accounts. We shifted 60% of your equity investments in your portfolios to a Vanguard short-term treasury ETF with the ticker symbol VGSH. That is, we moved 60% of the investments in your roof of your financial house to the walls of your financial house. This reallocation shift will likely be for a short period to intermediate period of time, potentially 6 months to a year. Carl, do you want to talk about why we did this?
Yeah, so the number one reason that we made this change is because we think there's a chance that the economy and the stock market could get considerably worse before we begin to see a gradual comeback to a healthy, normal functioning market. Also, our portfolios, which are doing considerably better than the overall stock market, are back up to where they were 5 or 6 months ago, thus giving us this unique opportunity. So if you'll take a look at this graph, you'll see this is a graph of the last 6 months. And down on the bottom of that graph is our finance portfolio, which over the last 6 months has been down quite a lot. So that is our smallest portfolio. We have that in there for some diversification. But as you move up there, you'll see the next one down about 11% is the Dow Jones Industrial Average. And then above that is the S&P 500, which is still down about 5%. And then comes our Roof 20 portfolio, which over the last 6 months is down just a little over 3%. But then starts coming our larger portfolios, which is VUG, that's a Vanguard Large Cap Growth. And that one is up for the 6-month period. And then we have the QQQ, which is an ETF that is also up for the 6-month period nicely. I think that one's up about 11%. And then up there on top is our tech stock portfolio, which has just been awesome for quite a few years now. In the last 6 months, it was up 25%. And that's one of our bigger portfolios. So those are a little bit of that unique opportunity that presented itself to maybe reposition, which is what we have done. Now, following are going to be the 5 reasons that we made the shift. Number one is every day that the entire workforce is not back to work and the entire population is not back out in the economy is a day that we lose thousands of businesses that will never open again. And I believe most of these forecasts for these businesses were based on much lower revenue projections only, and not what I believe will also be higher costs. So that doesn't just affect the business owner, it affects the business suppliers, the banks that gave them loans, the vendors that gave them credit, and all the employees that are working for them, et cetera, et cetera. So the ripple effect is going to be huge. And number two, Mike?
Number two, the banks will begin to have substantial increases in bad loans and charge-offs. The government will likely have to look at some sort of bank bailout package. The current stimulus package will likely not be enough for individuals or small businesses or state governments or airlines, etc.
And number three, we're still seeing revenues and profits from companies' quarterly reports, and they look pretty good right now, but they all reflect work that was generally in that pipeline before the shutdown. So I won't be until maybe next quarter or so that I think we're going to see what truly did and is happening. And I think it's going to be a lot worse. So saw a little thing from Mark Cuban recently who said it's actually going to be, he thought, brutal out there. And I know Mr. Cuban can be sensational, but he does have ownership in over 100 small businesses. So I think he's got a pretty good inside track, not only to what's happening with the economy, but also the government stimulus programs for those small businesses.
Number four, the country is opening back up in phases and likely slower than what may have originally been projected. Older people and those with medical conditions or having pre-existing conditions will be very slow to re-enter. And we'll have to deal with the whole resurgence of the coronavirus come fall.
Yeah,
I don't think it's over.
Yeah. Number five, it seems to be way more potential that bad things could be happening than good things. So businesses are declaring bankruptcy, revenues are continuing to decrease, costs are going up, unemployment is slow to get back to a normal range because of this, coronavirus flare-ups, resurgence in the fall, consumers slowing on their spending, taxes are probably going to need to go up to repay all the added debt. And for good things, mostly that's just going to be if we see something with vaccines, treatments, or a cure on the whole coronavirus thing. And I don't think that's coming anytime soon, or that it'll be 100% effective to just alleviate everyone's fears. So moving forward, we plan to watch for opportunities as the market moves lower to reallocate back to equities. And that may be a phase in. So for instance, it could be as the market drops 10%, we go in, 20% we go in, 25 a little more. We know that there's also a chance that the market may move a little higher before it begins to drop. But we also know we can't time things exactly. We're just trying to get close. And if suddenly we do have a cure or a vaccine and everyone can go back to work and everything's back to normal, then we may shift back to equities. But I really don't think that's likely to just happen anytime soon. So in summary, number one, we shifted a portion of the investments from the roof to the walls. Number two, we did it mainly because we think there's a greater chance the stock market is going to substantially be worse before it gets substantially better. And number three, we'll look for opportunities to reallocate strategically back into the market over the coming 6 months to a year. I'm really looking forward to being able to see you all again when we can get back out there into the marketplace. But till then, take care and stay safe.
Stay safe.